Okay, so I'm going to present you guys here with a very simple thought experiment that's going to outline how and why the earning strategy I'm about to explain works so well and why I've consistently printed money with this strategy on an 8-figure account. And yes, for those of you guys wondering, I'll actually show you here live on screen my account, and I'll refresh the tab here just so I don't get any of you doofuses in the comments saying, oh, you don't actually trade that account. So yes, I do, and that's why you should listen to what I'm about to say. So anyhow, let's get into this. I want you guys to imagine that you're watching an NFL game and you're watching the coin flip that happens at the beginning of the game. So bet number one is going to be very simple. Will the coin land on heads or tails? It's a very simple 50-50 bet. You either win or lose, and there's nothing in between. Bet number two is going to be a little bit more obscure. You win as long as the coin doesn't land on its edge and it balances perfectly. That's it. So as long as it lands normally on heads or tails, you're going to win. You only lose if it lands on its edge and balances perfectly. Now you're asking, how or why does this relate to trading earnings reports? Well, most people enjoy the dopamine-seeking thrill of betting 50-50 because they know if they're correct, the options that they bought, that they're betting on these earnings, they're going to skyrocket and probably, double their account, for example. But if you have any experience trading whatsoever, you know that this is just a completely unsustainable method. And that's why the strategy I'm going to explain totally flips that script. With my strategy, you make money no matter the direction the stock moves on earnings. It requires almost no capital to do it, and you can non-degenerately play every single earnings report with way more confidence and way less risk. Okay, so before we hop into the whiteboard to explain this, if you want the cheat sheet for what I'm about to explain, or you want to work one-on-one with me where I feed a small group of traders these exact types of earnings reports, plays every single week, you can click the link in the description and book a call with me personally. I show up to the call and we will get you going immediately on implementing these strategies. But anyway, let's hop into the whiteboard and I'm going to explain the very simple 3-step method that will leave you very confident in playing every earnings report. Okay, if you made it to the whiteboard, you're going to be very happy because the thing I'm about to explain is going to make you money, no doubt. So the strategy I'm going to talk about today is called the ER Condor, aka the earnings report Iron Condor. What I'm going to do is I'm going to explain the 4 steps or 3 steps that will make you better understand how to find plays that fit this strategy and then how to implement it. Then I'm going to go through a live example that shows you how to actually do these steps and then the ideal and worst case scenario. Okay, so first things first, very simple. You're going to want to scan for upcoming earnings reports. You can do this online. There's all types of calendars that show what stocks have upcoming earnings. Or if you're like me, I have different Bloomberg terminal scans that actually look for stocks that have a potential large move for earnings. So that one's probably the easiest of the 4 steps. So once you have your respective stock that you want to trade the earnings report on, you're going to want to understand IV and option pricing and how these relate to one another. So let's break this down very simply for you guys who may be new. So when you're trading options, if you're an option seller, you want option premium to be higher. So we want to find conditions that results in higher option premium. So when implied volatility, or actually we'll start even before, when a stock has an earnings report, right? So here's the earnings report. When it has an upcoming earnings, the market is expecting a large move in either direction, which means implied volatility on that stock is going to increase. When implied volatility increases, option premium is going to increase. When option premium increases, that means as an option seller, we're going to actually receive more money for selling to open those options. You can imagine this like in the insurance example where if you are insuring a house on the coast of Florida that had an upcoming hurricane, you're going to get a bigger premium for insuring that house when there's an upcoming hurricane. No difference. So once you understand that basic relationship, now obviously there's more, and if you aren't even familiar with what an Iron Condor is, I strongly suggest booking a call with me in the link in the description, theoptionlab.com. I've worked with a ton of you guys and helped you implement these types of strategies in your account. But anyway, step 3 is going to be picking your floor and ceiling of the iron condor. So let's start with the floor. In this case here, I have, an example here. We have NVIDIA, which obviously moves a lot, and especially it's going to move a lot on earnings. So picking your floor, we'll start with that. The floor is the price that we think the stock is going to stay above by expiration. So in this case, let's say we believe that the stock, say the earnings is on Thursday and, the expiration is Friday. So we need to pick a stock that after earnings and by our expiration, we have to pick a strike price that we think that the stock is going to stay above. So let's say in this case, we pick 125. That's going to be our floor. Then next is going to be picking a ceiling. This is the price that we think the stock is going to stay below by expiration. So in this case, we'll say 175. Now, this might be a little extreme going this far out, but I'll show you based on delta how to actually pick these. So typically, the delta that I'm choosing is for an earnings report is below 20. So this delta is going to be 0.2, and say this delta is 0.2, right? So delta, if you do 1 minus 0.2, you get 8. That means there's an 80% chance that this stock stays below 175 by expiration, and a 0.2 delta here means it's an 80% chance it stays above 125. So this is very similar to the coin flip example of, the odds that it lands on it perfectly on its edge and balances are very low. So now we've picked our floor and ceiling. This is the price that we think the stock is going to stay below as well as above. And then we're going to add our 2 protective legs. So when you sell to open an option, in this case, you're going to receive a premium to your account. And this is all going to be entered as one trade, by the way. But for these 2 legs that you're selling, you're going to receive a net credit to your account for opening those trades. Then you're going to add a protective debit leg above that 175 strike price call that you sold to open. So in this case, let's say it's the 180 call. And I should probably specify here that 175 option is going to be a call. So you'd sell to open -1 of the 175 call, and then +1 of the 180 call. So this is going to create a situation where you have a net credit, and the criteria for profit here is as long as the stock stays below 175, which is your sell leg, by expiration, you're going to collect that net credit. Then you're going to buy a put below your put option that you sold. So you're going to take here and you're going to buy plus 1 of the 120 put. And for that, you obviously are going to pay out a debit. And then this is going to be -1 of the 125 put, and then +1 of the 120 put. Okay, so this is going to create what's called an iron condor, where for these 2 trades here, this one and this one, you're going to receive a net credit. And as long as that stock stays between your 2 sell legs after earnings and by expiration on Friday, you are going to collect both of those net credits and walk away unscathed. So what is the ideal scenario in this case? The ideal scenario is that what I just said, that the stock stays below 175 and above 125 by expiration. The worst case scenario is, let's say the stock just rockets upward. So it goes, let's say it goes all the way up to 200. So this here, you're going to take a max loss. Now, keep in mind, if you don't understand how spreads and condors work, you're going to have to do more research, and I have a full course on this, but for the sake of this video, we'll make it simple. So you'd realize a max loss on this part of the condor, but then you would realize max gain on this side. So if you were to enter this separately, in other words, if you were to enter this as a bear call spread, this would take a full loss if the stock were to move that way, and this would take a full profit. So one offsets the other. Now, if neither happen, and it stays between, you're going to realize full profit. And then in the third scenario, if this were to drop below, you'd realize a full profit on the call side and a full loss on the bull put spread. Anyway, if that was helpful, please leave a comment, leave a like on this video, and let me know if you guys are going to implement the strategy or if you've had success implementing something like this in the past. And I will see you guys in the next one. Peace.